In today's video, we are going to focus on financial instruments. We are going to go deeper into everything about financial instruments. You start from the preliminary stage up to the advanced level. If you are writing financial reporting, I will inform you about those areas that are relevant to you. And if you are writing corporate reporting or strategic business reporting, I'll also inform you about those levels that are important to you. Most importantly, when you are reading or you are going to write financial reporting, then hedge accounting, derivatives and embedded derivatives, impairment of financial assets are not part of your syllabus. But this video, we will look at all those aspects. Those aspects that you'll be concerned about when you're going to write financial reporting has to do with how to classify financial instruments and the various types of financial instruments, how we classify them, because how you measure them depends on its classification. And we will not go into details about that is if it's financial reporting, okay? But don't be starting with corporate reporting and strategic business reporting. That one you need both the financial reporting and then advanced level, which has to do with the embedded derivatives, and then hedge accounting, as well as impairment of financial assets. So this video is going to be devoted for the discussion of such items. We cannot cover everything in this particular video, so we'll be doing it series or part by part, so you can document your understanding with the steps you'll be taking it. I'll take my time to go through all the preliminary things we need to comprehend financial instruments and also how to answer all questions that you will encounter under financial instruments. So as indicated, our topic for the day is financial instruments. Now, I didn't write any specific standard attached to the topic because this particular topic is governed by three different accounting standards. So we have IAS 32, which looks at the classification and presentation of financial instruments. So IAS 32 was basically established or developed to look at how to classify and how to present financial instruments. I indicated that how a financial instrument is measured. We have different, more than 10 types of financial instruments. So this standard looks at how you categorize, how you classify each type of financial instrument into the main classification. And how you will measure it depends on that classification. So if we are unable to attribute the right classification to the right instrument, let's say you have a question and the question is, the instrument there is about a compound instrument, it's about a derivative, and you are treating it as a financial asset, which is fair valued at amortized cost. You see, the measurement will be different, and for that matter, you get 0. So classification in financial instruments is very important, and I'll be focusing on that much because once you get the classification, measurement becomes easier. So IAS 32 looks at classification and presentation. Which figures should we send to statement of profit or loss? Which should go to statement of other comprehensive income? Which should we send to statement of changes in equity? Which must be presented in the financial position of the business, and which must go to the statement of cash flow? This standard looks at those presentations. Items that must go to their respective statement, and we have to ask resort to IAS 32. All right. Now, the next standard has to do with IFRS 9. And IFRS 9 looks at how we can recognize and how we can measure financial instruments. So after you've classified the financial instruments, how do you measure it? The next standard that looks at the recognition and Measurement is the International Financial Reporting Standard 9, basically devoted for the recognition and for the measurement of financial instruments. How do we initially measure financial instruments? How do we subsequently measure financial instruments? When should we recognize and or de-recognize an item of financial instrument from the books of an entity? All has been enshrined in IFRS 9. IFRS 9. So anytime we are doing anything about recognition and measurement, you know that we are going to resort to IFRS 9. If we are doing classification and measurement, then we will resort to IAS 32. Then we are going to climax our discussion with IFRS 7, which talks about disclosure of financial instruments. When we get to the impairment of financial assets, we are going to look at what we call credit risk and credit loss. Okay, when you look at lifetime expected loss and 12-month expected loss, these things are accounted for under the disclosure. It is when an entity is faced with credit risk. Credit risk is when the entity is unable or would default in the payment of money due their investors. Then the entity is faced with what? Credit risk. We also have market risk. We cannot get the information about these items if you don't go through IFRS 7. So IFRS 7, which talks about disclosure of financial instruments, also presents us with important information about key items that you need in the computation, in the presentation, in the recognition of financial instruments. So basically, our discussion is going to be based on these three important standards. Please, if you've not subscribed to RONAS Academy, kindly do so. I always say that this is the only thing you do to support the course. Spread the good news, share with others the content you are enjoying from us so that we can also reach out to wider markets. Share in groups, share in your class pages, tell them about RONAS Academy, and you are helping us to reach out to the wider market. Thank you for always being with us. Thank you for learning with us. All right. We will start with our presentation by looking at what is financial instrument. What is financial instrument? Please, the classification I've talked about starts from the definition of financial instrument. So if you barely want to know how to classify each financial instrument, then you barely have to understand the meaning and examples of financial instruments. So our presentation, we are commencing it with the meaning of financial instrument. When we talk about financial instrument, we are saying that it is a contract. Financial instrument is a contract that gives rise to two main instruments or two main items. It gives rise to a financial asset of one entity and financial liability or equity instrument of the other entity. So there is a coordinating conjunction that is bringing the distinction between financial liability or equity instrument. So when you talk about financial instruments, we are saying that it's a contract giving rise to financial assets of one entity and financial liability or equity instrument of another entity or equity instrument of another entity. So that is basically financial instrument. Once you are given a question, you should be able to distinguish whether the instrument in the question is a financial asset, is a financial liability or equity instrument. We have other forms of financial instrument. We have other forms, which is not part of the definition. So the other forms of financial instrument is what we call compound instruments. And all these I've mentioned so far you can be examined on it in financial reporting. But the next one is for corporate reporting or strategic business reporting. That has to do with, we also have another financial instrument. We call them derivatives. And derivatives are swaps, futures, options, and then forward contract derivatives. You look at it. Then we also have what we call embedded derivatives. Embedded derivatives. And we also have what we call hedge accounting. Hedge accounting, when entity is faced with risk and the entity wants to prevent those risks from, affecting its operating cash flows or affecting its fair values of the item, the entity can go for a contract or can enter into a contract to prevent those risks. The risk will bring about loss. The entity will also go and counteract the loss by investing in something that will bring gain. So the gain will cancel the loss. When the entity is doing that, we call it hedge accounting. And you'll be looking at it into details in this particular video. So basically, these are all the types of financial instruments. But remember that these are not featured in the definition. Financial instrument is a contract giving rise to financial assets of one entity and financial liability of another entity. What this definition means is that if we have A and B, now if B is issuing, B issued a loan note, or let's say a bond, and A is investing in a bond. You can see I'm using two different words over here. Classification, if you get your question, it is those keywords in the question that is going to inform you about which type of instrument you are dealing with. So you barely have to take into consideration of the keywords in the question. So I said that if B issued, so immediately you see the bond issue, you see that an investment entity or an entity is issuing financial instrument, then that instrument in the question can be looked at from a particular angle. And I said A is investing in the bond. So if A is the one investing and B is the one issuing, A is going to account for this instrument as a financial asset, while B will account for this as a financial liability. So it's a contract between A and B, but to A is a financial asset. To B is a financial liability. There are some times where B will issue equity shares. If B is issuing equity shares, which is the ordinary shares, then in that situation, we are not going to call it financial liability again. We will call it equity instrument. That is why it is financial liability or equity instrument. We will go deeper into each of them. But at least you know why this all is here. If this one is bond, so it's a loan or it's a debt instrument. It's debt. If the entity rather is issuing equity instrument, then we won't call it financial liability again, but we will call it all equity instrument. So it depends on what the entity is issuing. So from our presentation throughout till we end, anytime you see the word issued, sold, then you should know that we are making reference to financial liability. However, if you see the word invest, acquired, bought, then we are making reference to financial asset. What then is financial asset? What then is financial liability? What is equity instrument? Let's take financial asset first. Financial assets is explained with different complete sentences, about 5 complete sentences. So let's look at each of them. When we talk about financial asset, we are saying that it's cash or cash equivalent. Is cash or cash equivalent. Is contractual rights to receive cash. I can't write all of them, so you barely have to take notes. Contractual rights to receive cash. Not legal right, but contractual right to receive cash. Or an equity instrument of another entity. An equity instrument of another entity. Or contractual right to exchange financial instruments. Contractual right to exchange financial instruments under conditions that are potentially favorable. So we say that financial asset is cash or cash equivalent, or contractual right to receive cash, or an equity instrument of another entity. So if I invest in the equity instrument of another entity, that is also a financial asset. Or a contractual right or contractual arrangement to exchange one financial asset or one financial liability for another financial asset or another financial liability under conditions that are potentially favorable to the entity. When that happens, we are saying that that is a financial asset. If we are supposed to be doing financial reporting, we would have earned the definition there. But because I'm presenting on both corporate reporting, financial reporting, and then strategic business reporting, I'll add the last definition. Or is a non-derivative contract. Financial asset is a non-derivative contract in which the entity is or obliged to receive. So here the entity is or obliged to receive variable number of the entity's own equity instrument. Variable number of the entity's own equity instrument. So if it is contractual right to receive a variable number of equity instrument of the the entity's own equity instrument, then we are saying that that is a financial asset. Financial asset. Financial asset is a contractual right to receive cash, contractual right to exchange financial assets, contractual right of equity instrument of another entity, and cash and a non-derivative contract which the entity is obliged to receive variable number of the entity's own equity shares. All these are the meaning of financial asset. So you barely have to take note of which items are financial assets and which items are not financial assets based on the definition you look at. We will add the recognition criteria to it. So for you to identify that it's a financial asset, you have to know the definition and you have to know the recognition criteria. What are some examples of financial assets? We can look at trade receivable. Trade receivable is a typical example of financial assets. Trade receivable. We also have what we call equity shares. Okay, equity shares. Equity shares. We have what we call share option. Share option. This one is the derivative. Okay, so it's a financial asset which is a derivative. Share option. We may also have forward contract and the rest. So that is an example of financial asset. Now let's turn our attention to financial liability. When we talk about financial liability, we are saying that it's a contractual obligation to deliver cash. So here you are delivering cash. In financial assets we receive. So a contractual obligation to deliver cash or to exchange financial instruments. That means to exchange one financial asset or financial liability for another financial asset or financial liability under conditions that are potentially unfavorable to the entity. So under financial liability, we are exchanging these financial instruments under conditions that are potentially unfavorable to the entity. When that happens, we say that that is a financial liability. Again, if you want to add the last definition, which has to do with the corporate reporting or strategic business reporting, then we say that is a non-derivative contract. The non-derivative contract in which the entity is or is obliged to deliver. This one, the previous one is to receive. This one is to deliver a variable number of the entity's own equity instrument. When that happens, we say that is a financial liability. If trade receivable here is a typical example of financial assets, then here we have what we call trade payable. Trade payable as one of the examples of financial liability. We have bonds. We have bonds. We have long-term loans. Long-term loans. All these are examples, typical. We can even talk about debenture. Debenture. All these are typical examples of financial liability. Financial liability. Now let's look at the meaning of equity instrument. Equity instrument. When we talk about equity instrument, we are saying that it's a contract that evidences the residual interest. So When we talk about equity instrument, in this regard, in this perspective, we are looking at it that it is a contract that evidences the residual interest in the net asset of an entity after we have taken away all the liabilities of the entity. The contract evidences or evidencing the residual interest in the net asset of an entity after we have taken away all its total liabilities. That is an equity instrument. Like I indicated earlier on, a practical means for you to distinguish a financial liability from equity instrument is when it depends on what the entity is issuing. If the entity is issuing equity instrument, is issuing ordinary shares, then that becomes an example of equity instrument. And for this, there is no contractual right to deliver cash or contractual obligation to deliver cash. When it comes to equity instruments, there is no contractual obligation to deliver cash. When it comes here, there is a contractual obligation for the entity to deliver cash. But with equity instrument, there is no contractual obligation to deliver cash. Here we are just looking at a contract that evidence that you as an individual, you are having an interest in another entity, and that interest is the residual interest in the net assets of the entity. That is what we are focusing on over here. So we will take a practical example and look at how to distinguish between financial assets or what is a financial instrument and what is not a financial instrument. We also take a question to look at what is a financial liability and what is not financial liability, or we will look at the distinction between financial liability and then equity instrument. So that is it with the definition of financial instruments. We said that it's a contract that gives rise to two things. It gives rise to financial asset of one entity and financial liability or equity instrument of another entity. And I said that when we talk about financial instrument, it's not limited to financial assets and financial liability, but they are not mentioned. The others are not mentioned in the definition, and I listed them over here. That we have compound instrument being one of the, we will be looking at it being one example of financial instruments. We have derivatives, we have embedded derivatives, and we have what we call hedge accounting. All these are examples of financial instruments. We will be taking one by one. Remember I said that the measurement of the various types of financial instruments depends on how you classify them, and the classification commences or starts from the meaning of the financial instrument. So you barely have to understand the definition of all that I have indicated here before we add up the recognition criteria. So when should we recognize financial instrument in the books of the entity? When should we recognize financial instrument in the books of the entity? Recognition criteria. An entity should recognize financial instrument if and only if an entity should recognize financial instrument, that means financial asset or financial liability, if and only if that entity is a party to the contractual provisions of the instrument. So, if the arrangement that is bringing the parties together is about legal arrangement, it's about statutory arrangement, it is not about contractual arrangement, that is not a financial instrument. For instance, an entity is obliged to pay tax because it is a legal or statutory arrangement. That is not financial instrument. We recognize financial instruments if and only if the entity is a party to the contractual, the word there is contractual provisions of the entity. Anytime it is outside this jurisdiction, then it is not financial instrument. Then we may apply a different standard accounting for it. In the case of tax, we would have gone for International Accounting Standard 12, taxation, which talks about how to recognize tax. So please take note of when to recognize financial instruments. So let's take some few list of items and see whether they fall within the category of financial instruments or they don't fall within the category of financial instruments. And why will we say that this one is within the category of financial instruments, or this one is not within the category of financial instruments? Let's take those scenarios, because it will help us in establishing our understanding more. All right. So we want to proceed our discussion, and here we want to look at the items on the screen. We want to see how we will distinguish them. Are they financial instruments? The first set is, are they financial instruments or they are not financial instruments? We have inventories. So inventories. Looking at the definition of financial instruments, we said it's a contractual right to receive or contractual obligation to transfer cash. Inventories are they are goods we are receiving. Goods we are receiving. They are not cash or cash equivalent. So inventories are non-financial instruments or financial assets. Inventories in this question is not a financial instrument. Investment in ordinary shares. Obviously investment in ordinary shares will be what? Will be a financial instrument, because it meets the definition and the recognition criteria of financial instruments. Let's see, prepayment for goods or services. Prepayment for goods, and you have prepaid for a good or for a service. Now, this prepayment for a goods or services, there is only a contractual right to receive goods or services. It is not a contractual right to receive cash. Pay attention. You've prepaid for a good. The only contract that is existing is to receive good or a service. You don't have any contractual right to receive cash or cash equivalent or any financial assets. So this prepayment of goods and services is not a financial instrument. It's not a financial instrument. Then we have liability for income taxes. Liability for income taxes. As I indicated in the recognition criteria, that the only arrangement for which we must account for financial instruments is when there is a contractual arrangement, when the party is bound by the contractual provisions of the instrument, not legal or statutory provisions. For this matter, this income tax here will not be accounted for as financial instruments. Then we have share option. Of course, I mentioned it as one of the examples of financial asset. For that matter, is a financial instrument. It's a financial instrument. So you see, based on the definition and the recognition criteria, we should be able to distinguish between items that are financial instruments and items that are not financial instruments in nature. Now, let's look at another set of questions. Here, our focus is, let's look at the requirement of the question. So, discuss whether these financial instruments should be classified as financial liabilities or equity in the financial statement of Costa for the year ended 30th September 2023. So here the focus is, we said that financial instrument is a contract that gives rise to financial asset of one entity and financial liability or equity instrument of another entity. Now this question here is trying to test our understanding as to whether we will be able to classify an instrument into financial liability or equity instrument. So here we are leaving the broader term, which is the financial instrument. We are going into a narrower way, which is financial, what's the name? Financial liability or equity instrument. Financial liability or equity instrument. Financial liability or equity instrument. So let's take the scenarios one by one. Costa wishes to purchase a new ride for each Animation Galaxy item pack, but requires extra funding. So on 30th September 2013, Costa issued the following preference shares. So we have three types. Now we are going to determine whether this is going to be financial liability or this is going to be an equity instrument. That is the focus of the question. 1 million preference shares for $3 each. No dividends are payable, so there's no contractual rights over there. Costa would redeem the preference shares in 3 years' time by issuing ordinary shares worth 3 million. By issuing ordinary shares worth 3 million. There's that number of ordinary shares issuable will be based on their fair value on 30th September 2026. Hello. So if you look at the question on the screen carefully, the very first point one, you can see that we don't know the exact number of shares. That means the exact number of shares is going to be a variable number of shares. Equity shares, we know, equity instrument, we know the fixed number of shares that will be issued. But when it comes to financial liability, if you remember the definition for a non-derivative contract in which the entity is or is obliged to deliver variable number of the entity's own equity shares. Look, this is it. It said the exact number of ordinary shares issuable will be based on their fair value on 30th. We don't know. So when we get there, it can vary. So for this matter, the point one is a financial liability, not an equity instrument. Let's look at two. 2 million preference shares for 2.8 each. No dividends are payable. The preference shares will be redeemed in 2 years' time by issuing 3 million ordinary shares. Look at, see the difference here. Now we know how much ordinary shares we are issuing. So for this matter, this is an equity instrument. It's not variable. Let's look at the last one. 4 million preference shares for 2.5 each. They are not mandatorily redeemable. A dividend is payable if and only if dividends are paid. Once dividends are paid, then dividends are payable. For this matter, there is a contractual obligation to deliver cash. Because if dividends are paid, they will also pay dividends. So there is a contractual right to receive what? To deliver what? Cash. So for this matter, this is a financial liability, not an equity instrument. So you can say that for you to distinguish between financial liability and equity instrument, first of all, look at what is happening to the shares they are issuing. Is it variable or is fixed? If it's variable, it's a financial liability. Is there a contractual obligation to deliver cash? If that's the case, then it's a financial liability. In the absence of these, we can say that it's an equity instrument. So that is it with the distinction from items that are financial instruments and items that are not financial instruments, and also items that are financial liability and items that are not financial liability. At this juncture, we are now going to focus on the individual items one by one. First of all, you take financial liability. Then next, we will take compound instrument. When we are done with compound instrument, then we will take financial assets. Then we will go into impairment of financial assets. Then we will take derivatives. Then we take embedded derivatives. Then we take hedge accounting. Each will be a different separate video. Okay, so the financial liability will take a different separate video. All will take a different separate video so that we can make the videos short. For easy understanding. So for this matter, we are going to end this one here. This is an introduction aspect, introduction and recognition of financial instruments. So we are going to end this one here. Then in our next lesson, we are going to take financial liability. All right. Thank you.